Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribbled down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. And now for this week's question.
Okay, this week's question is, how do I pay myself back when doing infinite banking? How does that work exactly? Well, so when you borrow money against your life insurance policy, first of all, let's talk about this. You're not borrowing money from your policy. You're not borrowing money from yourself, not directly anyway. You are borrowing money from the life insurance company, always and everywhere. You're borrowing money from the life insurance company. The life insurance policy is an asset. It's in a sense, a capital asset. You're taking out a loan against that asset. So that asset is being used as collateral, as security. That's why the life insurance company is offering the loan, because they know that they have security in the form of the life insurance policy. That's kind of part of how and why this whole thing works. If it was as simple as just withdrawing the money from an account, there wouldn't be much of anything to it. It would just be like going down to a savings account or whatever and just withdrawing the money. And it also would not be a loan. So there'd be different tax implications, different rules for withdrawals and stuff like that. It's a loan. It's a real loan. You are borrowing money against the value of your policy. That's why you can only borrow so much. You know, the loans are limited by your net cash surrender value minus a small holdback that the company has to use to just as a buffer so that your policy doesn't accidentally lapse, when they're issuing the loan, because they have to have collateral. They have to have security to make it a true loan. So when you borrow money against your life insurance policy, you must set up a formal written repayment schedule if you want to track payments to yourself. Notice I said if. Okay. The life insurance company is not going to force you to make payments back to your policy. They're not going to come after you for life insurance policy loan payments. Nobody will. It's your policy. You own it. Okay. So you own the contract. The money sits with the carrier. The carrier controls that money. Okay. And you're, in a sense, kind of handing it over to them to manage. They have equitable ownership in it, but you own the contract that gives you rights. You own the contract so that you can control what happens with the policy, and then which gives you a legal and equitable right to that money. Without getting into too much of the legal stuff, technically the life insurance company owns the money, but you own the life insurance company in a mutual company anyway. But you own the life insurance company and you own the contract that gives you rights to that money. So it can get to be kind of a complex legal structure when you start thinking about it. But the long and short of it is you are borrowing money from the life insurance company. You don't have to pay that loan back because you're the policy owner. You control the terms of whether or not you're paying this money back. And so you have an option to pay it back. But most people who borrow, they want to pay it back. They want to be in the infinite banking world, there's this thing called, being the honest banker. Don't steal the peas. You want to be the honest banker and you want to be paying yourself back. Well, to do that, you set up an amortization schedule. Just like a bank would set up a repayment or amortization schedule if you took out a mortgage, car loan. They're giving you a repayment schedule. It's the loan amortized over a number of years, whether it's a 5-year term, 7-year, 10, 15, whatever it is, whatever the loan term is, you're paying that loan back over a set number of years. And then, paying yourself back for a loan just means that you're going to stick to that set schedule that has a set term or repayment period. So if it's a 5-year term, you keep making payments for 5 years. What's going to happen is, for example, you might let's say you take out a policy loan for 5 years and make $200 per month repayments. At some point prior to the end of those 5 years, your policy loan principal will actually be fully repaid. All of the interest to the insurance company will also be paid. So you don't actually technically owe the insurance company anything because the loan's repaid. Maybe this happens in year 3 or 4 or whatever, but let's assume it happens in year 3. For the next 2 years, you keep making payments to yourself, okay? And these are counted as interest payments to yourself. This is part of being the honest banker, right? If you had, let's say, taken out a loan, a 5-year loan with a bank or some other lender, you'd still be paying principal and interest on that loan, for the full 5 years, unless you made extra payments. In the life insurance loan, you're not making extra payments. It's just the way the loans work. You actually end up paying it off early because you pay principal and interest. You pay principal on the policy loan before you pay interest. So that tends to help shorten the loan term a little bit. And then if you're using market rates instead of the rates that the insurance carriers are giving you, you're naturally just paying the loan off faster. So anyway, let's assume that you pay it off in year 3 and you keep making payments. So the difference in the last 2 years is that you're paying yourself instead of paying another lender. So this works the same way the honor system works. If you remember that, you I don't know if you've ever gone to a business, or back when I lived in New York, we had this farmers market in Ithaca, New York, which I went to occasionally. I didn't live in Ithaca, but I would go there to go to the farmers market. And so there were some people who it wasn't like major sellers or anything, but sometimes you'd have people operating on the honor system. You pay them, you just put money in, and they weren't checking it. They were just assuming that you were paying them. And other small businesses around the area where it was, I've done this with farmers who sold eggs and milk and stuff like that directly from, you go to the farm, you'd buy something, there'd just be they wouldn't be there. They would just have left the stuff for you. They'd leave the milk for you in a fridge, or the eggs out or whatnot. And they're just like a metal box, and just like, hey, you owe me $2 or you owe me $10 or whatever it was, and you just throw the money in the bin and the tin, and it was an honor system. Like, nobody was checking whether or not you actually paid the full amount or not. But that's just, that's the level of trust you have. So if you're the type of person that can do that with other people, then you can do that with yourself. And if you can't, be honest with yourself, this is absolutely not the financial strategy with you. And I say that like a little bit tongue in cheek, but there are a lot of people who are not honest with themselves. Like, they are just not honest people. And it's not like mustache twirling villains evil. They're just not honest with themselves. Like, they delude themselves and they evade. And so, like, they're not going to do that. The honor system for them is they're going to find ways to cheat. Those people should not be doing infinite banking or anything like that, because it's not going to work for them, because they're not honest with themselves about making payments back to themselves. So they're simply not going to do it. And they should not be doing stuff like this until they can solve that problem first. I'm not saying they should never do it. They should just not do it until they can sort out that mental hang up they have with themselves. So anyway, rant aside, it works like the honor system. And if you don't pay yourself, nobody is going to come after you. But you also cheat yourself out of future savings. So a bank wouldn't let you skip out on those last 2 years of loan payments. So, like, my thinking is, like, why would you skip out on yourself? The bank's money is presumably more valuable than yours, right? And then you kind of have to think like the bank in order to make this work. So if you're willing to pay the bank that much money, why would you not be willing to pay yourself at least as much money as you were willing to pay the bank? So the amount that you pay yourself can be put into your savings account, some other investment, or stuffed under your mattress. But most policyholders, what they do is they'll pay themselves back, put it into their savings or checking account, and then take that money and then add it back into their policy. And that's what most policyholders will find that, the most value in buying paid up additional life insurance through the PUA rider, the paid up additions rider on their policy. And if you do that and you buy additional PUAs, it increases the death benefit of the policy, and as a result, the cash surrender value. And that makes a bigger pot of money for you to then go and do this again in the future. And that's it in a nutshell. I mean, there's Nelson Nash wrote a whole book about this and using examples and drawing things out. But I mean, that's the nutshell of it. You build up policy values. It takes, a couple of years. Whenever you need money for something, you can borrow from the insurance company and then pay it back. And you pay it back at a, if prime rates are 5%, then you treat yourself as prime plus 1, prime plus 2. The loan amount or the repayment rate that you're making should be higher than, what the insurance company is charging you. Assume they're charging you in like a more of a wholesale rate, a non-retail rate. Because if you look at kind of the mechanics of how it works, they're not charging you a lot. The net rate is not a lot because the dividends are helping to offset the interest that you're paying back to the policy in some ways. In a direct way, under a direct recognition. In other ways, it's indirect, under non-direct recognition loans. But either way, that's being offset a little bit. So you sort of have to assume that the carrier is charging you in some ways like a net wholesale rate, even though they'll never say that. But I mean, if you look at it, you just kind of put 2 and 2 together. And so you're going to charge yourself more than that and pay back the loan. And again, being the honest banker. And then, and then your policy values grow. And it's when you do that, when you do it correctly, your policy values just continue to grow. So it's not a difficult concept. I mean, you can read books and books and books and books on this, and like 20 books on the concept. It's at the end of the day, that's really all there is to it. It's not a complicated thing. People sometimes make it complicated and they think there's some kind of magic to it or there's something more to it. But, it's borrowing, it's repaying, it's being honest with yourself. And, the big thing is that you're owning and controlling your own capital. And when you have ownership and control over your own capital, then, that's what makes it work. When you have access, when you can tap into this and borrow against that capital and still retain ownership over it. Now, I have to pledge it for security, but you still retain ownership over it. You don't have to give up ownership over the capital or give up control over the capital like you do in a lot of other types of lending scenarios. That's what really helps make it work well. And so it's a combination of that, both ownership, control, and the ability to borrow. With the caveat being, you should repay it, because if you don't, then the whole thing falls apart. But anyway, that's how you pay yourself, quote unquote, pay yourself back, right? But that's how you pay yourself back on policy loans. You pay off the carrier first, and then you keep making those additional payments to pay yourself back the additional amounts. And again, that goes into your checking or savings account, and then you use that money. Most people will use that money to buy additional paid up life insurance. I hope that helps clear things up if there's any questions about that. And that's it for this week. I'll see you next week with another question.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.